It's been an interesting start to the month for SoFi stock. We saw the stock drop about 10% in a single session, then almost get it all back within a day or two. I've been a SoFi shareholder for almost 6 months, and I've seen this stock struggle to break out and regain all its losses from last year. I managed a dollar cost average in the past 6 months and maintain an average just under $18. I think we can all agree SoFi has lots of upside, but one thing the market isn't agreeing on is where fair value sits in the short term. I've seen analysts rate SoFi a hold right around $18 a share. Another came away with a strong buy and a price target as high as $26. As for the earnings report, it didn't disappoint. Adjusted net revenue hit about $1.21 billion, up 40% year over year. Adjusted EBITDA jumped 40% to roughly 358 million. GAAP net income landed near 157 million, marking SoFi's 11th straight profitable quarter. Membership grew to 15.8 million, up 35%, and products in use grew even faster, up 45%. Loan originations hit record of 14.8 billion, up 69% from a year ago. So why is this stock not flying? My guess is guidance. CEO Anthony Noto explained that SoFi kept its 2026 EPS guidance at 60 cents because of uncertainty around interest rates, choosing to keep a cushion while continuing to invest in long-term growth. SoFi also expects to keep investing heavily for future growth. At first, investors did not like this news, but there is an important detail that gets overlooked in my opinion. SoFi's guidance now assumes that its tax rate will be about 7 percentage points higher than originally expected. It also assumes that the Fed could raise interest rates one or two times in 2026. So even though SoFi did not raise its guidance, they are actually expecting to reach that same number under tougher conditions. That makes the forecast look better than it may seem at first. There is another important part of SoFi's business that investors should understand. SoFi generates loans, but it doesn't always keep those loans on its own books. It can sell some of those loans to other investors. One major investor is Blue Owl Capital. Earlier this year, the private lending market ran into problems. Some investors wanted their money back from private credit funds. That created a problem for SoFi because it could have made it harder to sell loans to outside investors. And we did see SoFi's loan sales to outside investors fall sharply from a peak of about 30.7 billion to around 3 billion. But SoFi did have another option. Instead of selling those loans, SoFi was able to keep more of them and fund them using money from customer deposits. This brings us to what I think is the biggest thing every SoFi investor should be watching, and that is credit risk. Credit risk means the risk that people who borrowed money from SoFi stop making their payments. SoFi is still mainly a lending company, and a large part of its business comes from personal loans. These loans can become risky if the economy gets worse and people start losing their jobs. For now, the numbers look pretty good. The average SoFi borrower has a FICO credit score of about 742 and an average income of nearly $150,000. SoFi's loan losses have also improved to around 3%. That's well below the company's expected range of roughly 7 to 8%. So here is what happens to these loans if, let's say, the economy enters a serious recession. SoFi's loan business has not yet been tested by a major economic downturn, and that is one of the biggest reasons some analysts are still cautious about the stock. Now let's talk about what SoFi could actually be worth. Different analysts are using different methods to answer that question. One common method is to look at SoFi's three main businesses separately. You got lending, financial services, and its technology business. Using this method, some analysts estimate that SoFi is worth around $19 per share. That's pretty close to where the stock is trading right now. The more bullish view looks at how quickly SoFi's book value is growing. Book value is what the company owns after subtracting what it owes. These analysts compare SoFi to larger banks and believe SoFi could eventually deserve a higher value. That puts their estimate closer to around $24 per share. There's also another way to look at SoFi. I like to focus on return on tangible equity. How much profit is SoFi making compared with the money shareholders have invested in the company? Right now, that number is around 7%. SoFi's long term goal is to get that number closer to 20 to 30%. If SoFi can actually reach those levels, they could become much more profitable. The problem is that investors may already be paying for some of that future growth today. So, yes, SoFi had a very strong quarter, but the bigger question is what happens next? Can SoFi keep growing this quickly while the stock is already trading at a fairly high price? Can its banking business give it a big enough advantage to keep funding loans? And most importantly, can SoFi keep its loan losses under control if the economy gets worse? Also, another thing to watch for is if SoFi's loans sold to outside investors recover from recent drop and get back to above 3.1 billion. Overall, I think the business is moving in the right direction. But at this point, the biggest question isn't whether SoFi is growing, because it clearly is. The real question is whether SoFi can grow fast enough to justify what investors are paying for the stock today. If you found this breakdown helpful, make sure to subscribe and check out my other stock related videos. Until next time, goodbye.